Hey traders, Nick here. Wanted to do a little video about what's going on the 15th today. I'm recording it today. I won't share it until tomorrow before the market opens. So the stock market fell today, but the IWM, which represents a basket of 2,000 shares, stocks, is flat to green, to red, to green, so they're about flattish. So not the end of the world. So what happened today? I already wrote it up yesterday. Quick summary is the fact that we had a spike in rates. So this is the S&P, but we knew it wasn't going to be a straight shot higher. In fact, it went too long. We had 8 green days in a row. So I had drawn this zigzag, right? And this is the first zag. It's been zig, 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 and just one zag. So totally okay. But the underlying problem is a problem and could be a much, much bigger problem. And this is the point of this video. I just want you to see both sides of the fence to really appreciate the risk that's involved should the you-know-what hit the fan. All right, so this is the S&P. So what's at stake today? Today we are watching, the media, is watching this candle right there. That represents the 10-year yield. So rates. And you remember 3% was the end of the world. And that caused the correction in February. When was that? 2nd? Right there. Right here was when we had a good jobs report. Markets started freaking out over rising rates, and we started a whole correction. Since then, we've been around 3-ish. We fell. And then we, in fact, started falling with it falling. So markets were wanting the rates to go up. And here they are back up. And now they're freaking out again for exactly the same reason on a different report. Today we had 2 reports. One was retail sales or something was hotter than expected on, quote, prices paid. So that's underlying inflation, if you want to think about it that way. So now the fear comes back. Same one from here to here is, oh my gosh, the Fed's going to be spiking rates faster than they want to. I think the fear is that we don't think that the Fed is in control, so we don't want runaway rates just driven by market. Okay, that would be bad, and that's the point of this video. So, quick note, rates rise, bonds fall. That is like, the sun rises from here to here always. That's rates rise, bonds fall. They don't rise at the same time. They don't fall at the same time. I've never seen them do that. Okay, so so spiking rates would mean the bonds fall, right? So the bonds have been too high for too long, and they've been called dead by the experts that follow bond for years. Why? Because rates are rising. Why are bonds not falling, right? And here it is. This is the TLT represents bonds. A while back, not too long ago, I shared a video on bonds. Can't remember when, but I drew this red circle. And the circle, I said, the fact that something will happen here. I don't want to curse, but, crap is going to happen in this box. Either we continue on higher, or we're going to have a massive start of something massive to come. So by massive, I mean something significant. I shouldn't say massive. Massive, just dramatic. Significant. There is going to be a significant change in the bond market / rates. And that drives stocks. There is no, at least for the short term, that whipsaws stocks, regardless of how positive I am on Apple or Google or whatever. They will have to follow what the bond market dictates. So if I look at this right away, I see this is short term. This is... keep this picture in mind. Okay, I can redo this. This is short term, so there's been a neckline of sorts. It's not a hard line in the sand. It's a zone for me. There's been a shoulder, a poke, and another shoulder. So if they lose this neckline, should be the drop down here. So going to, let's say, break par, break 100. I look to the left. I think they will stop here and then stop here. So target 1 is 110, target 2 is eyeball 103. Okay, that target 1, target 2. If this breaks, technically it should be the size of this. Okay, taking this apart. I don't think the story is this short. I'm going to go to a 5-year chart. Oh, this is a 5-year chart. So I'm going to do a monthly candle. Boom. So this is going back to 2005 and beyond. And this is the 08 crisis, 2010 crisis, 2011 crisis, flash crash, 1014 crisis, and you see how it's pivoting around this. Look at where my circle is. This is the neckline we're talking about. So this is the zone we're talking about. Remember 110 and then 102, whatever. So you can tell long term, this is a significant pivot point. So is this really the death of bond now? Is this it? That's the question. So I can draw a head and shoulders. I don't want to mess up take the time, but you see the same head and shoulders, shoulder, shoulder, shoulder. I mean shoulder, shoulder, and head in the middle. If this neckline breaks, and it's not a hard line in the sand, it's just whenever the market decides to freak out over it, they're going to go to this point, which was the last pivot point, or this point. And by the way, on the breach of this line right here, this is the target somewhere down here. So everything, all the confluence comes to the fact that bonds need a bounce. Otherwise, what's going to happen? Rates are going to skyrocket. Which brings me to the scary scenario. So we are freaking out over 3.07%. Okay? 3.5, in my opinion, is a given if we close above this on a monthly basis. This is a monthly candle. So at the end of the month, if we're above this line-ish, emphatically, 3.5 is next and could come in hours or days. But the good news is if it comes, it should be resistance because it was a long-term pivot point. So rates rising is a problem, especially if it's not the job of the Fed doing it. If it's rising just because the market is wanting it to rise, that is a scary proposition for stocks for the short term. Knee-jerk reaction could start something sinister. So what do? It means I don't get overextended. I don't sell naked puts in stocks that are frothy. I sell naked puts in stock that I want to own at the puts I'm selling. So if I sell a naked put in Apple at 125, I know I'm not going to go bankrupt owning Apple at 125. And that's just one example. I don't sell puts in Tesla, that's for sure, naked. Because Tesla can go to zero if they run out of money. If they can't borrow because rates are too high, they have to shut down their doors. They can't operate. Anyway, exaggerating, but I want to show the point. I'm not scaring anybody, but I'm telling you that rising rates for the wrong reason, meaning it or in the wrong fashion, is a serious short-term problem. And I have to take it into consideration. So how do I protect? I can short the SPY by buying puts in the SPY, or if I have a lot of no names, I'll do it in the IWM, or RUT, or SPX, or QQQ if I'm long Apple and Google and all of that. So it depends on what I'm long. I'll buy puts in those. Or put spreads. I can buy them near the term, like out in time, but near current price. So if I spend 50 cents to buy a $1 white spread, I could decide the next 2 days, you know what, I'm not that scared anymore. I can sell them back out for partial gains or losses. I did that this morning. Okay, that's one way of doing it. Another way is to buy the TBT, which is like rates. That's a ultra short 20-year treasury. So if TLT is falling, this one is rising. And this one, we've seen this level before. So it's not like that we're freaking out, but the markets are freaking out. So if I go to 120 minutes, so 2-hour chart, we were right here. Here we are. Left a big gap down here. So we've seen this before. So far, it's been a toppy formation. Okay, so, but it's an opportunity for the bulls of that thing to take it higher. How so? If you remember the yellow arcs that I had in the QQQ, technically they're an opportunity. When you see a cup and a handle, and then they break the brim, they rise by as much as this. So there is worry, and I just wanted to explain the whole situation. So again, a summary. Spiking rates, if it's not normal raising rates from the Fed, is scary because the bond market is a lot bigger than the stock market, and it whipsaw the stock market. So it's a concern long term. I can do it via shorting the TLT by buying puts in the TLT or buying calls in the TBT, which is what you're looking at here. The TLT represents bonds. The TBT will represent shorting the bonds, basically going long rates. I can buy the TNX, but there are no options at the TNX. The TBT has options, and I can buy calls there. So everything ties into how the rates are rising and for what reason. To me, 3.0 or 3.1 is not a big deal, but runaway rates for the wrong reason is a big deal, and I have to pay attention to it. So I keep my risk in check. If you have any questions, let me know. Nick signing out.